Hey everyone, Ryan Bolton here. I am a mortgage nerd. I work with Patriot Home Mortgage. And today I want to talk to you about what are points, how do they work, and should you pay points on your next mortgage loan? So let's dive right into it. So, what are points? Points are money you're paying upfront to reduce your interest rate. Points is simply a term for percentage of the loan. So, 1 point is 1%. I've often heard also a half point, or you'll see numbers that's maybe a random kind of number of like 0.784 or 0.627 or whatever that number is the difference of buying a rate down for every step down. Usually they go in eighth of a percent increments, but you sometimes won't see much of a move, say from 7.5 to 7.625. You won't see a big difference, but you'll see a bigger jump if it's a quarter difference. So all you're doing is simply paying upfront money to reduce the rate to the next tier down. So you will run into a cap where you can't just kind of keep buying it down to the point where your rate's like 2% or something crazy. So it is something where once you get to a certain amount, they don't let you buy it down any further. And it does get more expensive the more you get past 2 and 3 points. So the simple term is points is a percent of the loan. So how does that even work? Let's check out the next slide. So, how do points work? Generally, 1% of your loan amount, not of the sales price, but the loan amount, 1% will usually buy you a quarter percent off the interest rate. Now, I've seen times where it's a little bit more than 1 point or a little less than 1 point to get that first quarter off the loan. And then I've seen times where if you try to go another quarter on the interest rate, it jumps up to maybe 2 or 2 and a quarter or 2.5. So every day, the pricing is different between those base rates and the rate you're actually going to get depending on how much you're willing to pay. And sometimes it's not exactly 1 point. I've seen it, 0.877% or something like that. So generally you're going to see these numbers fluctuate based on market demand, where the bond market's at, just how those interest rates are being put out there. Something you also see is what's called LLPAs, which is loan level price adjustments. This is offsetting the risk of that particular scenario. You'll have risk like credit score. So the lower the credit score, the more the hit to the pricing, which you either have to pay as points or build it into rate, will go off of that risk. Same thing with loan to value. Obviously, the higher the loan to value, the more they have to offset that risk with either a higher rate or higher fee to get the same rate. Same with property type. So this is like a manufactured home or a condo, townhome, single family, all the different property types. And of course, a big one is the property use. If it's a primary residence or an investment property, there's different hits to the interest rate or the fee to get that interest rate. So that's how those things work. What we're seeing right now is points have definitely gone up because of something called APOR. Let's talk about that real quick. So APOR was created as the average prime offer rate. So when the Dodd-Frank bill happened after 2008, they wanted to set a benchmark for what interest rates were on a given week. And if you were over that rate, if you were advertising or quoting a rate that was more than that, it would become a non-qualified mortgage. So during the Dodd-Frank era, they started adding what is an actual mortgage. So then they could start regulating if it didn't fall into those categories. It's a way to kind of deregulate or get rid of subprime mortgages, because if you didn't follow the rules that they had created, then you were outside of any kind of protections or any kind of bailout opportunity or anything that qualified as an actual mortgage. So anything that's an FHA or government backed or conventional loan is going to follow those guidelines of what is a qualified mortgage. So if you go over this APOR, which is an average rate that's available plus a little bit of a margin, then you can't offer that loan on conventional loans. So what it forced is it kind of forced interest rates to not allow them to kind of go up as quickly as we've seen. So we've kind of seen a ceiling, an artificial ceiling that's been created. Even if clients wanted a higher rate to get rid of the fees, unfortunately you can't anymore. It's something where once that rate is achieved, you basically just have to pay a combination of points to get that rate. So we run into that problem when it's a investment property or low credit scores or something like that. You start running into too many hits where you can't go any higher on the interest rate. So APOR has had kind of a consequence of not allowing rates to be up above a certain percentage, even if the hits are more than that percentage. So as you see rates really move up, that you kind of bump into APOR a lot quicker, where if that is stabilized and you start seeing the average rate start to even out, then you're able to see where you don't have to pay as many points to get the top rates. So we'll see how this plays out as interest rates go up or down over the next couple of years. But it's definitely coming into play as people are trying to get their mortgage, where you are seeing the cost, even though it's really just buying down those hits, you can't build into the rate like you were able to even a few years ago. So now let's ask a question. Should you pay points? That's really probably the ultimate question that most people are asking is it worth paying the points? So let me show you some formulas on how I figure out for clients if it's valuable, if it's actually worth paying the points. Okay, should I pay points? Let's take an example. We have a $300,000 loan amount. We're going to do a 30-year term. We're going to take a rate of 7.5%. Now, this isn't the rate that's available today. It's just something to show an example. So this is not advertising that particular interest rate for any clients that are out there. Every interest rate is going to be different, but there's a lot of compliance when it comes to advertising an interest rate. So I just want to use this as a mathematical example of how this works. So let's take a rate of 7.5% on a 30-year fixed at $300,000 for the loan amount. This would put your payment at $2,097.65. Now let's pay 1 point or $3,000. This would lower your rate to 7.25. This would lower the payment by $51.13. So what I always do is I say, okay, it cost me $3,000 to save $51. Where is the break-even point? So 3,000 divided by $51.13 is $58.67. That's how many months you have to keep the loan to break even on what you upfront paid. So if you divide that by 12, that's 4.89 years. So almost 5 years, you got to save $51 to earn back the $3,000 it cost you for that loan. Now, over the entire life of the loan, it'll save you $15,406, but that's after 30 years. So for the first 5 years, you're just paying yourself back. After that, you're actually saving the $51 per month. So if you don't think you're going to keep it that long, and maybe you're going to upgrade, downgrade, or interest rates will change or go up or go down or something like that, you may want to look at not paying the extra money. Because I look and say, okay, where can $3,000 go that can save you more than $51 a month? Maybe you could refinance the car or pay off another debt or just emergency funds or savings. Sometimes it's worth running the math on it to figure out if it's really worth buying down the interest rate. Now, if it's a forever home, last home, maybe it makes sense. But I like to at least show the client, okay, here's how that particular scenario works out. Now, this will work on $400,000, $500,000, $1 million. It'll always work out to about the same 4 to 5 year break even point. Then after that's when really the savings starts kicking in. So just keep that in mind, run the math. It's a really simple formula. The cost versus the savings will give you a monthly amount, then divide that by 12, and that'll give you the years you have to keep that loan. So I hope that makes sense. I hope you enjoyed this video. It was really fun putting it together, and I have a lot of questions about how points work. See a lot of questions on Quora and other places like that. But I'd love to do a specific calculation for you, get you pre-approved, show you what your payment's going to be like, and show you the different loan programs you might qualify for. So if you're looking for a loan in Utah, Nevada, that's where I'm licensed. I can help you in other states, just have to refer that to my network of referral partners. I mean, I've been doing this 25 years, so I have lenders and friends almost in every state that loan in this business. So if you're looking for a loan outside of Utah and Nevada, I can get you to the right person. But I'd love to earn your business. You can check out my websites just down below here, ryanbolton.com. You can schedule an appointment, or we can just talk without having to pull your credit, without doing an application. We can just kind of get an idea where you're at. And I'd love to earn your business. So check out my website at ryanbolton.com, and we'll see you on the next video.